a quiet rule change that will reshape global banking. It is early morning, before most Americans wake up, before Wall Street opens, before the headlines change. A new banking rule quietly goes into effect, and almost no one is talking about it. On January 13th, 2026, the final phase of Basel III, known as the Basel III Endgame, officially becomes law. This is not a proposal, not a debate, not a rumor. It is binding on every major bank in the world. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, they all must comply. This rule was published by the Bank for International Settlements, often called the Central Bank of Central Banks, and yet mainstream financial media has barely mentioned it. Why does this matter? Because this is the largest structural change to the global banking system since the 2008 financial crisis. Back then, banks collapsed because they were over-leveraged, they held too much risk, they didn't have enough real capital. Basel III was designed to fix that, and now, with this final phase, the system changes again permanently. This rule forces banks to reevaluate what counts as real money, what counts as safe, what counts as trustworthy in times of crisis. And for the first time in more than 50 years, the answer is no longer just paper assets, something long dismissed, something many people were told was outdated, is being quietly brought back into the heart of the financial system. And what happens next will affect banks, retirement accounts, savings, and everyday Americans. Who really controls the global banking system? To understand why this rule matters so much, you first need to understand who is behind it. Most people believe the Federal Reserve sits at the top of the financial system. But above the Fed, there is another institution. It's called the Bank for International Settlements, or BIS. The BIS is not a commercial bank. It doesn't serve the public. It doesn't answer to voters. Instead, it serves central banks. The Federal Reserve answers to it. So does the European Central Bank. So does the Bank of England, the Bank of Japan, and dozens more. That's why the BIS is often called the Central Bank of Central Banks. When the BIS changes the rules, global banks do not argue. They comply. After the 2008 financial crisis, the BIS came to a dangerous conclusion. Banks around the world were fragile. They were overloaded with risky assets, and they did not hold enough capital to survive a real shock. So the BIS introduced a new framework called Basel III, not all at once, but slowly, deliberately. Phase 1 in 2013, Phase 2 in 2019. Each phase tightened the rules, each phase reduced risk, each phase forced banks to hold stronger capital, and now, in 2026, we reach the final phase, the end game. This last phase closes the loopholes. It redefines what banks are allowed to trust, and more importantly, what they are no longer allowed to rely on. The moment gold and silver quietly become money again. For more than half a century, gold and silver were treated as relics, outdated, old-fashioned, useful for jewelry, but not for serious banking. That changed overnight. Under the Basel III endgame rules, something unprecedented happens. Physical gold and physical silver, when properly stored, audited, and fully allocated, are officially reclassified as Tier 1 banking assets. That places them in the same category as cash. And U.S. Treasury bonds. This is not symbolic. This is mathematical. Tier 1 assets are the safest assets a bank can hold. They strengthen balance sheets. They reduce regulatory pressure. They determine whether a bank is considered stable or vulnerable. Before this rule, gold and silver were treated like stocks. Risky, inefficient, penalized. Banks had to discount their value by 50% for regulatory purposes. That meant holding precious metals made no sense. Now the opposite is true. If a bank holds $100 million in physical gold or silver, it counts as $100 million of core capital. No penalty, no haircut, no discount. This change quietly remonetizes precious metals, not through speeches, not through a gold standard, but through incentives that force banks to treat metal as real money again. For the first time since 1971, gold and silver are no longer outside the system. They are back inside it. And this single reclassification sets off a chain reaction that most people are completely unprepared for. Paper gold and paper silver are now a liability. While physical gold and silver are being promoted, something else is being quietly pushed to the edge. Paper gold, paper silver, and unallocated precious metal accounts. Under the new Basel III endgame rules, these assets are no longer treated gently. Any precious metal position that is not fully backed by physical metal in a vault is now classified as a high-risk derivative. That includes futures, swaps, options, and most unallocated accounts. The penalty is severe. These positions receive an 85% risk weighting. In simple terms, that means banks must hold far more capital just to keep them on their books. They also require expensive long-term funding to support them. This changes everything. Before, paper, gold, and silver were cheap to hold, easy to trade, efficient for banks. Now they are a burden. Every dollar in paper metal weakens a bank's balance sheet. Every position makes regulatory compliance harder. Banks are given a clear choice: hold physical metals and be rewarded, or hold paper metal and be punished. The incentive structure has flipped completely, and when incentives change, behavior follows. Banks are no longer motivated to support paper markets. They are motivated to shrink them. This is why unallocated accounts are suddenly at risk. What was once marketed as convenient exposure is now treated as something dangerous, not because of price, but because of regulation. And when regulation turns against an asset, it rarely ends quietly. Why short-selling gold and silver suddenly becomes dangerous. For decades, banks made money one simple way. They sold gold and silver they didn't actually own. This practice is called short selling. On paper, it looked safe, efficient, profitable. But under the Basel III endgame rules, that strategy breaks down fast. Starting now, any bank holding a short position in gold or silver faces a new reality. They must hold additional Tier 1 capital just to maintain that position, and not a little. If a bank's short exposure becomes too large, regulators can step in. Dividends can be restricted. Executive bonuses can be frozen. That changes the math completely. Tier 1 capital is expensive. It's shareholder money, and shareholders demand returns. So when a bank is forced to tie up hundreds of millions of dollars just to stay short, the trade stops making sense. The profit is small. The cost is massive. The risk is no longer optional. This makes naked short selling economically unviable, not illegal, just impossible to justify. And when banks can't afford to stay short, they do the only thing they can. They buy back what they sold. They cover their positions. And when many large institutions rush to do that at the same time, the market doesn't move slowly. It snaps. This is how short squeezes begin. Not because of speculation, not because of retail traders, but because regulation forces the exit. The evidence: banks are already covering their shorts. This is not theory, this is not speculation, and it is not something that might happen in the future. It is already happening. In the days leading up to the Basel III endgame deadline, something unusual appeared in the data. Open interest in gold and silver futures began to fall sharply. That matters. Open interest measures how many contracts are still open. When it drops quickly, it usually means one thing: short sellers are closing positions. In just 1 week, silver futures saw tens of thousands of contracts disappear. That represents hundreds of millions of ounces of paper silver removed from the market. Gold showed the same pattern. These positions weren't closed by accident. They weren't rolled forward. They were covered. Banks are racing against the clock. They know that once the new capital rules fully apply, holding short positions becomes extremely expensive. So they are acting early, quietly, urgently, and largely out of public view. But here's the problem: when too many large institutions try to exit at the same time, liquidity disappears. Prices don't adjust gradually. They jump. This is how short squeezes are born, not from hype, but from necessity. And this wave of covering is only the beginning. Many banks are waiting until the last possible moment, hoping prices stay low. But history shows what happens when everyone rushes for the door at once. The door is never big enough. The 78-day countdown that changes everything. Here is where the pressure truly begins. Although the Basel III endgame rules take effect immediately, banks are given a short transition window to fully comply. But that window is not generous. Banks have 78 days. By mid-February, they must show meaningful progress. By the end of March, full compliance is required. That may sound reasonable until you understand what compliance actually means. Banks must either close their unallocated precious metal positions or back them with real physical metal. Not promises, not contracts, not paper claims, physical gold, physical silver. And this is where the system strains. The global precious metals market is not built for sudden demand of this size. It never was. Banks are not allowed to wait years. They are not allowed to delay. They must act now. That means acquiring massive amounts of physical metal in a very short time. Every day that passes tightens the squeeze. Every delay increases urgency. This is not a slow-moving policy change. It's a countdown. And countdowns force decisions. Banks that wait too long risk penalties, restrictions, and regulatory scrutiny. Banks that act early compete for limited supply. Either way, pressure builds. And when deadlines collide with shortages, markets don't stay calm. They react violently. The math problem. The silver market cannot solve. Now comes the part no one wants to talk about. The math. According to the latest global banking data, banks hold hundreds of billions of dollars in unallocated precious metal positions. These are paper claims, fractional reserve promises, not backed by real metal. Under the new rules, these positions must change. Let's assume banks do what they usually do. They close most positions, but not all. Even if only a portion is converted into physical metal, the numbers become staggering. Banks would need to acquire tens of millions of ounces of gold and hundreds of millions of ounces of silver, and that's where the system breaks. Global silver mine production sounds large until you break it down monthly. Even then, most of that silver is already spoken for. Industrial use, electronics, solar panels, existing contracts. What's actually available for new buyers each month is a fraction of what banks need. Banks may need hundreds of millions of ounces. The market can deliver only a small percentage of that in time. That gap cannot be negotiated away. It cannot be delayed. It cannot be printed. There is only one mechanism that closes shortages of this size: price. When demand overwhelms supply, prices rise until someone is forced to sell. That's not opinion. That's how markets work. And this demand isn't optional. It's regulatory. The 30-day warning for unallocated account holders. Now the focus shifts away from banks and directly onto individual investors. If you own gold or silver through an unallocated account, this rule affects you personally. Under the Basel III endgame requirements, banks can no longer treat unallocated precious metal accounts as low-cost products. They are now expensive, capital-intensive, and heavily penalized by regulation. As a result, banks must act. Within 30 days, account holders are required to be notified, and when that notice arrives, you are given three choices. First option, convert your holdings into allocated metal. That means real metal held in your name, stored in a vault, fully audited, but it also means new storage and insurance fees. Second option, liquidate the account. Your metal exposure disappears. You receive cash instead at current market prices. Third option, roll your position into a bank-issued metal-backed security. This turns you from a metal owner into a creditor. That third option carries risk most people don't fully understand. If the bank fails, unsecured creditors are last in line. This is why unallocated accounts are no longer just convenient. They are vulnerable. Millions of investors believed they owned metal. What they actually owned was a promise. And when millions of people receive the same warning at the same time, some will panic. Some will demand allocation, and that creates a second wave of physical buying pressure, right when supply is already strained. The chain reaction, hitting bonds, rates, and the dollar. When banks are forced to buy large amounts of gold and silver, they must first get the cash, and that money has to come from somewhere. Banks don't create capital out of thin air. They sell other assets. The most obvious candidates are U.S. Treasury bonds, corporate bonds, and in some cases, equities. As banks sell bonds to raise liquidity, bond prices fall, and when bond prices fall, yields rise. That means interest rates move higher, not because the economy is strong, but because capital is being pulled out of the bond market. At the same time, banks are shifting away from dollar-based paper assets and toward hard assets. That puts pressure on the U.S. dollar. This is happening during an already fragile period. Inflation remains elevated, economic growth is slowing, consumers are stretched, and geopolitical risk remains high. This combination has a name: stagflation, slow growth, rising prices, higher interest rates. Historically, this is one of the worst environments for traditional financial assets. Stocks struggle, bonds lose value, cash purchasing power erodes, but hard assets behave differently. Gold and silver tend to benefit, not because of speculation, but because they sit outside the debt-based system. Basel III doesn't create this environment. It accelerates it. What this means for your savings and retirement. For most Americans, this is no longer an abstract financial story. It's personal. If you are retired or close to retirement, your financial security depends on stability. Savings accounts, pensions, 401ks, IRAs. These systems are built on trust in paper assets, but Basel III sends a quiet message. Not all assets are equal anymore. Banks are being told by regulation to reduce exposure to paper risk and strengthen their balance sheets with assets that hold value without promises. That should make investors pause, because when banks change behavior, markets follow. If bond values fall, retirement portfolios feel it. If interest rates rise, borrowing costs increase. If the dollar weakens, purchasing power erodes. This creates a dangerous environment for those living on fixed income. You may notice it slowly at first. Groceries cost more, insurance premiums rise, medical expenses climb, but your savings don't stretch as far. That's why many investors look for balance, not to abandon traditional assets, but to diversify. Assets that do not depend on debt, assets that do not require trust in counterparties, assets that are not someone else's liability. Basel III doesn't tell individuals what to do, but it shows you what banks are doing. And sometimes that's the most important signal of all. Why $100 silver is no longer a question of if. For years, price targets for silver sounded like hype. Too optimistic, too speculative, too far removed from reality. But Basel III changes that conversation completely. This time, rising silver prices are not driven by retail investors, not driven by social media, not driven by excitement. They are driven by regulatory necessity. Banks are being forced to buy physical silver, not because they want exposure, but because they must comply with capital rules. When demand is optional, prices fluctuate. When demand is mandatory, prices adjust upward, and silver is uniquely vulnerable. Unlike gold, silver has heavy industrial demand. Electronics, medical equipment, solar energy, that demand doesn't disappear when prices rise. At the same time, banks are required to secure massive quantities of physical metal within a short compliance window. When you combine limited supply, industrial usage, and forced buying, the result is predictable. Prices must rise until balance is restored. That's why $100 silver is no longer an extreme scenario. It becomes a mathematical outcome. $120, $150, even higher levels are no longer theoretical if shortages persist. This doesn't require panic. It doesn't require fear. It requires understanding. When regulation collides with reality, markets don't ask permission. They move. The 78-day action plan. What to do and what to avoid. So the question becomes simple. What should you do right now? The next 78 days are not about chasing profits. They are about positioning and protection. First, understand your exposure. If you hold precious metals through banks, brokers, or ETFs, you need to know one thing clearly. Is your metal allocated, or is it just a promise? If it's unallocated, you will be forced to make a decision anyway. The rules demand it. Waiting does not reduce risk. It concentrates it. Second, avoid emotional decisions. Volatility is coming. Prices will move quickly, up and down. That does not mean panic buying, and it does not mean panic selling. Regulatory-driven markets behave differently from speculative markets. They move in waves, not straight lines. Third, understand what not to rely on. Paper claims, leverage, short-term trades based on headlines. Those strategies work in calm systems. This is not a calm system. The banks already know this. They are reducing risk. They are strengthening balance sheets. They are preparing for a different environment. You don't need to copy banks, but you should pay attention to what they are doing, not what they are saying, because when rules change, the safest position is clarity. When the rules change, the game changes. On January 13th, 2026, something fundamental changed, not with a speech, not with an announcement, not with breaking news on television, but with a rule. The Basel III endgame quietly rewrote the incentives of the global banking system. Gold and silver were brought back, not as nostalgia, but as recognized money inside the system. Paper promises were pushed aside, leverage was discouraged, risk was repriced. Banks didn't argue, they adjusted, they reduced exposure, they covered shorts, they moved toward what regulators defined as real. And history tells us something important. When banks are forced to change behavior, markets eventually follow. This is not about fear. It's about awareness. Most people won't realize what happened until prices move, accounts change, and options narrow. By then, the opportunity to prepare has already passed. You don't need to predict the future to understand this moment. You only need to recognize that the rules are different now, and when the rules change, doing nothing is still a decision. This is not the end of the story. It's the beginning of a new financial chapter, one shaped less by confidence and more by compliance. The question is not whether the system will adjust. It already is. The question is whether you saw it in time.